We have taxation, chapter 35. When we talk about taxation, it's simply about a levy that is imposed by government on individuals, firms to gain revenue, which they can as well use for infrastructure, fi finance public expenditure or public goods. So here they said, reason for taxation. At least you know what taxation is already. A levy imposed by government, a compulsory levy imposed by governments on individuals, firms, to raise government revenue that can be used for public spending. So government uses taxation for a number of purposes. Number one, to pay for government expenditure. Government needs to raise finance for their expenditure programs. They can borrow a limited amount of money for this, but most of the finance must come from taxation if inflation is to be avoided. So the first point about, let me have it. The first purpose of taxation is to generate, to pay government expenditure. Paying government expenditure. Here they said, government need to raise finance. So see, it simply means government budget will determine, government budget in terms of revenue will determine how much government would spend. But sometimes government might have as well have to borrow money from institutions, from individuals, from IMF and the West. But as soon as they borrow this money, if they continue to borrow, it will lead to national debt. Do you get the point? But so most of government expenditure should be funded through taxation. Two, to correct market failure, such as externalities. Government can intervene in individual markets by changing taxes and thus changing demand. For instance, tobacco consumption can be reduced by raising taxes on cigarettes. Pollution can be controlled by imposing pollution taxes, or sales of books can be increased by exempting them from VAT. Used in this way, taxation becomes a way of increasing economic efficiency. So there are three things I mentioned here. The first one is about externalities. Externality is simply about spillover. It could be positive or negative. Here, when there's negative externalities like consumption of tobacco, this will create cigarettes, and or pollution, this will create negative externality. So government can impose taxes on these things so that they become disincentive for people to want to do. So government can increase taxes on demerit goods like tobacco or pollution to reduce it. And as soon as government does that, the reason why you're doing it would reduce, because if you continue to do it, it increases your cost. And if it increases the cost, it increases government revenue. And also on the other hand, government might as well use taxation for positive externalities to encourage the consumption of goods that are beneficial to the society. Example is the book. So government might exempt people from paying VAT buying book, because if government have to take taxes on the consumption of book or buying of book, it simply means government is discouraging people to study. And as a result of that, it could bring about inefficiency in the society. So that's another point. Government trying to use taxation to correct market failure, such as externalities. For positive externality, government might cut taxes. For negative externalities, government might impose tax. I think the point is clear there. The third one, to manage the economy as a whole, taxation can have an important influence on the macroeconomic performance of the economy. Government may change tax rates in order to influence variables such as inflation, unemployment, and the balance of payment. Now, inflation. Inflation is a persistent rise in prices of goods and services. Government might use taxes to correct that. So if there is demand pull inflation, government might as well increase VAT. Are you with me? Or government might as well increase income tax to reduce demand for goods and services. Because as soon as government increases tax on VAT or taxes on income, people start having that, they don't want to buy more because their purchasing power reduces, their disposable income reduces, and that might as well reduce demand pull inflation. So increase in taxation might be used to correct demand pull inflation. Do you get the point there? And a cut in tax might be used to reduce cost push inflation. Does it make sense there? That's about that's inflation. Then we have unemployment. Unemployment, government might as well use taxes to reduce unemployment. Government might, reduce income tax. And if government reduce income tax, people on them, that's voluntary unemployment here. The zeal will be there. People who has a disincentive, who have the disincentive or who are disincentivized to work might as well want to work now. And government might also, cut corporation tax. If government cuts corporation tax, it simply means firms will be making much more profit than they used to make. And as a result of that, they might want to expand. Expansion would,
Investment.
yeah, investment too. And that might increase demand for labor, reducing unemployment. I think that one's
Yeah.
clear. And the last one is the balance of payments. Government might also use taxation to improve the balance of payments. How can government do that? Government might reduce um, corporation tax. And if government reduces corporation tax, the cost of production for firms, exporting firms reduces. And if the cost of production for exporting firms reduces, it simply means the price of exportation would reduce. And that might make them internationally competitive. So more exports will improve the balance of payment. I think the point is clear there.
Yeah.
Yeah. So we'll move on to, now they said one way to classify taxes is to, sorry. Yeah, it said one way to classify taxes is to make the distinction between direct and indirect taxes. Now, we have direct taxes, we have indirect taxes. Now, let's look at direct taxes. I said a direct tax is a tax levied directly on individuals or companies. Example of direct taxes used by many economies include we have income tax, corporation tax, capital gain tax. We have inheritance tax, social security contributions. Okay, and those are the five type of direct tax talked about here. So I'm going to start with the first one, income tax. Are you with me?
Yep.
For income tax, we're talking about tax that individuals' income earners have responsibility for paying. So it's an income tax because it is charged on your income. And for income tax, it could be for other businesses like unlimited liability businesses like sole trader and partnership. So not only individuals or employees that pay income taxes. Businesses do pay income taxes, but when we talk about these businesses, yeah, we're talking about um, sole trade businesses and partnership. They pay income tax.
Okay.
But whichever way, it is a direct tax. Then we have corporation tax. For corporation tax, we're talking about a tax paid by companies levied on company profits. So for firms, they pay taxes too, but this tax is on whatever the profits they make. So they have to pay taxes on that. Then we have CGT, capital gain tax, a tax which is paid on the profit made when assets such as bonds and shares are sold. It is tax based on the gain in value of an asset. In football, they use capital gain tax too. So when you buy a footballer, and okay, probably you purchase the club purchased the footballer for 30 million, and if the team is able to sell it for maybe 35 or 40 after 1 year, there's a capital gain tax. But how do they calculate that gain tax? They take away the amount spent on him plus the capital invested in the player and its salary. Then they take away the amount is being sold.
Yeah, okay.
So that's how they get their capital gain tax.
Mhm.
I think that one is clear.
Yeah.
Okay.
Inheritance tax.
Inheritance or estate tax. A tax paid by a person who received money or property due to the death of its previous owner. That's inheritance tax. For inheritance tax, it's based on what you have inherited. So you have to pay taxes on that. It's a direct tax too.
It's not fair though.
Why is it not fair? It's fair because what reason for inheritance tax is that it sometimes discourage people to rely mostly on inheritance.
Yeah, also someone could just give it all of it to charity and that's it.
Yeah, so the point about inheritance tax is that it's 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 it increases government revenue.
Mhm.
It increases government revenue. And probably when you pay inheritance tax, that might as well make you to think further, like, oh, this thing I've paid so much on it. I wouldn't want to just mess around with it. Then we have social security contributions. And another reason why inheritance tax is being paid is to reduce inequality. So you having an inheritance that it simply means you are ahead of others. who are of the same level or the same caliber or the same, income level. But right now, you've inherited the property, that increases your value. That gives you advantage over them.
Mhm.
So inheritance tax sometimes is used to reduce the gap between the rich and the poor. So if government wants to redistribute income, government could use progressive tax and inheritance tax. Are you with me?
Mhm.
Then we have social security contribution. Are you there? Are you there with me?
Yep.
Compulsory payments by both employees and employers. These are payments to the government as a form of insurance premium. This means individuals will gain the future social benefits, which includes unemployment benefits, sickness benefits, hospital expenses, etc. Strictly speaking, social security contributions are not taxes because they are a form of insurance premium. However, increasingly they have come to be seen and used by government as a form of tax. For social security, it's a contribution, but it's a contribution towards your welfare. Do you get the point here? It's a
Mhm.
contribution towards your own welfare. So we wouldn't see it as a tax because it's what you are getting back, what you have what you have paid, and you might as well get more than that.
Mhm.
Do you
Okay.
understand? Yeah, you might as well get more than that.
Okay.
But the point is, paying it means you allow government to have more revenue.
Mhm.
So these are forms of indirect tax. These are forms of direct taxes. So we have indirect tax. So can I use your phone to make a video, please?
Okay.
Yeah,
Okay.
then you send it to me later.
Mhm.
Okay, thank you. Okay, backward, forward. Okay. So, oh, the phone is so.
Is the lighting good
No,
or
it's good. It's good. Okay. Well,
clearer?
more clear. Yeah, it's
Okay.
clear. Okay, thank you. Let me use it. Okay. Use it here. Okay. So for indirect taxes, why do we call them indirect taxes? We call them indirect taxes because they are levied on goods and or services. So example is the VAT. So here they said an indirect tax is a tax levied on goods or services. Example, value-added tax, known in some country as a goods and services tax. Excise duties, taxes on specific groups of products for example, tobacco. Then we have custom duties. These are for imported goods. A tax on either the export or import of goods or services. So these are forms of indirect taxes. And why do we really call them indirect taxes? We call them indirect taxes because they have to be remitted into government's purse. Government are not taking it from you. So it has to be paid through a third party, which is the business, before it gets to government. So it is remitted into government accounts. That's why we call them indirect taxes. I think that is clear.
Mhm.
Okay, then it said economies will raise tax revenue from both direct and indirect taxes. For example, as reported by the Times of India, the proportion of total tax revenue in India in the 2017 and 18 budget from direct taxes was 50%. And okay, hold on. 50% made up by 23% from personal income tax, 27% from corporation tax. So when you look at this start, they said 22% from personal income tax and 27% from corporate taxing. So the 23% would have um, unlimited liability businesses like sole traders and partnership among them with individuals. You get it?
Mhm.
But the largest proportion of tax paid through direct tax is from the businesses, from limited liability companies. That was the point they make there. And they said and 49% from indirect tax is made up by 33% from the goods and services tax. So they do more of that. And that is the point. They do more of that. 11% excise duties and 5% from custom duties. So this simply means India does not really do importation if it's only 5%. I think it's clear.
Yep.
So, well, all in all, government would generate revenue through income tax and through direct taxes and indirect taxes. And that's about that. Any question?
No.
Okay, then we have the distinction between progressive tax, progressive, proportional, and regressive taxes. Are you there?
Mm-hmm.
Okay, great. Another way of classifying taxes is to make the distinction between progressive, proportional, and regressive. So we're going to start with progressive tax. A progressive tax is a tax where the proportion of income paid in tax rises as the income of the taxpayer rises. So we call it progressive tax because it's a tax charged on high income earners. So if you earn more, you pay more in taxes. Most of the time, government uses this is when they want to redistribute income. I think you're getting that, please.
Yeah.
So income tax will be progressive if a worker paid 5% tax on income of 4,000 per year, but 25% on income of 40,000. So direct taxes on income tend to be progressive. People earning very low income pay no income tax, while those on very high income pay a high tax rate. So when you look at it, when you earn 4,000, you pay how much is the tax paid there for 4,000? 5%. Now when you're earning times 10 of that, you're paying times 5 as tax.
Mm.
So that's an example of progressive tax. So the more income you earn, the more likely you pay in terms of tax. Then we have, okay, they said direct taxes on income. Yeah, I talked about that. So corporation tax could be considered progressive because taxes on profit might be paid for by paying less in dividends to shareholders. Individual shareholders tend to be higher income individuals. Also, in many countries, there are two different rates of corporation tax: a lower rate for those making a profit below a particular amount, and a higher rate above this. So here, corporation tax. Corporation tax could also as well be a progressive tax because it simply means you pay more if dividends that you have to pay. If your profit is increasing, you pay more in taxes. But there are differences. We have for small and medium sized businesses, we have micro businesses, we have large businesses. So the amount of tax they pay on profit differs because their turnover is not the same.
Okay.
That's the point I'm making here. I think it's clear.
Yep.
Then we have CGT, capital gain tax. It is progressive because it is paid only by those with enough assets to make capital gains over the yearly allowance. These are likely to be high income individuals. Yeah. What will a person that is in low income or someone that is wallowing in abject poverty have or have inheritance? No. So it simply means inheritance goes mostly to high income earners. So they already have, and you're giving them more. So if
Progressive.
without progressive tax, government might not be able to, there's no way government wants to take from them. But through progressive tax, it becomes, an official way to make them pay and reduce the gap. Do you
Tax
get
the
it?
rich and feed the poor.
Tax the rich and feed the poor. Well, we will say, yeah, it is, but it is redistribution of income. It's government's objective, and it's important, trust me. So that's about progressive. Yeah, I told you earlier that progressive tax could be through inheritance tax. So for progressive tax, example of progressive tax we could have here, capital gain tax, corporation tax, income tax, and inheritance tax, right? Now go to regressive tax. Why do we call it regressive tax?
Why?
Why? Okay, we said a regressive tax is a tax where the proportion of income paid in tax falls as the income of the taxpayer rises. Indirect taxes such as VAT tend to be regressive. As income increases, households tend to spend less as a proportion of income and save more. The result is that taxes on spending fall as a proportion of the income as income rises. Taxes on cigarettes tend to be highly regressive because they form a much larger percentage of spending for low-income households than higher-income households. Now, let's look at regressive tax. We call it regressive tax because as you pay less as soon as your income increases. Not that you're paying less because of the price. You're paying less because the proportion of what you are spending for consumption starts reducing. That's why it is regressive. So it simply means those that are on high income, that are high income earners, will spend the same amount of money, the same amount of money on certain quantity of goods with low income earners, and that makes it regressive. So the more income you earn, the less proportion of it you pay on taxes, and that might allow you to buy more in terms of quantity than those with low income earners. So it puts you in an advantage over there, and that advantage is simply why it is regressive. Does it make sense here?
Mhm.
And here they said taxes on cigarettes. So if government is charging tax, putting tax on, increasing tax on cigarettes, high income earners is just going to take little proportion of their income, but it's going to take much from low income earners. And that's the point. That is why it's also what? Regressive tax. So mostly consumption, VAT, value added tax, is regressive because it doesn't take the same proportion or the same percentage of income on households. Yeah, it is constant, but what I have to pay, the proportion of what I have to pay will determine if it's income elastic or it's elastic or inelastic. The amount of money you pay,
Yeah.
the proportion of what you pay. So that's why it is regressive. They have a proportional tax. A proportional tax is one where the proportion paid in tax remains the same when the incomes of the taxpayer changes, although the actual amount paid increases as income increases. For example, a taxpayer might earn $10,000 and pay $1,000 in tax. If tax increases to $2,000, when income rises to $20,000, then the tax is proportional over the income range. So it is proportional because you're paying a tax that is proportional to your income. So whatever happens, the tax you pay is directly linked to the amount of money you earn. That is proportional. You earn less, you pay less. You earn more, you pay more. That makes it proportional. It is not the same as regressive. It is not the same as progressive. For progressive, it is only paid by high income earners. So it's not like when you earn less, when you are a low income earner, it doesn't even come to you at all. And that's the difference between progressive tax and proportional tax. For proportionate or proportional tax, you earn more. It is directly linked to the tax you pay is directly linked to the income you earn. Earn more, pay more. Earn less, pay less. For progressive tax, earn more, pay more. Low income, they don't pay. I think it's clear. Any question about the types of taxes we have here?
No.
Proportional,
Regressive and
regressive, and
progressive.
progressive. Thank you. We can stop this one here. I'll be right back, please. Yes, let me just stop this first.
Can you open AirDrop?
We have income tax, average and marginal rates of tax. So in most income tax systems, there is an amount of income which can be earned which is not taxed. This is called the tax exemption level of income or tax allowance. The rest of the income is called the taxable income. For the taxable income, the tax rate tends to rise as income rises. This means each additional dollar earned might be taxed at a higher rate than the one before. Income tax is therefore a progressive tax. It is important to understand the marginal rate of income tax differs from the average rate. For example, now before we go into that, there is what we call taxable income. Taxable income are income that we earn that taxes have to be levied on. Then we have exemptions. Sometimes government might give tax allowance, mostly to low income earners. Government might give tax allowance and or tax exemption. So, but whenever it is taxable income, it is a taxable income because taxes are levied on that income you earn. And it is stated that all income tax are mostly progressive tax, which simply means you might as well earn $10 yesterday and earning $12 today, you might be paying more. So that means for the additional $2 that you've earned today, you'll be paying more than what you used to pay. I think that point is clear there.
Yeah.
So we'll move on. These are average tax amounts. So we'll go to the economic effects of changes in direct and indirect taxes. Are you there?
Yep.
I would need to make a video for that.
Okay. Let's try something again first.
Okay. Your face. Doesn't matter.
Oh, okay.
Is it gonna? I doubt it's on live.
Okay, leave it.
It's not gonna. Well, I think that's the other one I'm gonna do. Let's see. Thank you. Okay. So we have, I hope I recorded it. Let's see. Was okay, yeah. Okay. So we have the economic effects of changes in direct and indirect tax rates. Changes in direct and indirect tax rates will have an impact on a number of economic variables, including incentive to work, tax revenue, and so on. So we're going to start with the first one here. They said incentives to work. When we talk about incentive to work, we're simply talking about the motive before the motive behind your motive for working. So changes in tax might be a reason why you want to work or be the reason why you're not going to work. So I'm going to read further anyway. It said, high marginal rate of tax, the rate of tax on last $1 earned or spent discourage economic activity. So a tax on cigarettes leads to fewer cigarettes being bought. A tax on work income tax leads to people working less. A tax on profit discourages firms from making profits. Lowering certain taxes will therefore raise the level of economic activity and increase aggregate supply. So the first one we're going to talk about is aggregate supply, which is the total supply within the economy. So if government increases marginal rate of tax, it simply means what you previously pay on tax, right, is lesser than what you are paying presently. And that simply means in the future you have to pay more. That discourages you from spending. That's for marginal rate of tax. Then when it comes to income tax, an increase in income tax reduces the purchasing power of individuals. It reduces your willingness to buy. It desensifies you from buying. And because as a result of that, you might not even want to work more. So people will start thinking about not working because because income tax is progressive. So it simply means we work more, we pay more. So what's the point of working? So that's become a disincentive for people to work, increasing income tax. Then for corporation tax, if government charges more corporation tax, it simply means firms might as well not want to make profits anymore because the more profit they make, based on the fact that corporation tax is progressive tax. It means you make more profit, you pay more tax on it. So firms might be disincentivized from making profit. And if firms do not have any reason to produce, if workers do not have any reasons to work, if individuals do not have any reason to consume, it simply means decline in economic activity. So if government wants to raise economic activity, government must find a way to cut taxes. Well, an increase in tax will bring about a fall in aggregate supply. And a fall in aggregate supply bring about a fall in economic activity. I think the point is clear there.
Yep.
So move on here, they said, free market economies believe that the supply of labor is relatively elastic. What supply of labor, please?
Supply of labor is the amount of workers making themselves available for jobs.
Thank you. So the supply of labor is the numbers of workers making themselves available for job. So they said the free market economies believe that the supply of labor is relatively elastic. And what does that simply mean? If the supply of labor is relatively elastic?
So depending on the wages, there is a proportional supply of labor.
So does it mean that an increase in wage increases the supply of labor?
Yes.
Ah, okay. So there's direct relationship between wage and supply of labor. That's what it means. So,
Yes, sir.
okay, thank you. So when we say we have a relatively elastic supply of labor, it simply means there's direct relationship between wage rate and the supply of labor. So what does that simply implies? It simply means that as soon as the wage rate increases, workers start having incentive. They are incentivized to work because they know they're going to earn more. So that is why the supply of labor is elastic. So here they said, okay, a reduction in marginal tax rate on income will lead to a significant increase in work. This could mean individual working longer hours, being more willing to accept promotion, being more geographically mobile, or simply being prepared to join the workforce. Now, the marginal rate of tax, which is about the additional money you earn or the additional money you spend that you pay tax on. So if the additional money you earn, you're going to pay less tax. So here they're saying a cut in marginal rate of tax is an incentive for people to want to work, because it simply means when you earn more, the additional money you earn more, you're not going to pay tax on it. So that's an incentive for people to want to work. It's an incentive to accept promotion. When the marginal, look at it this way, if government increases taxes on marginal rates, there's an increase in the marginal rate of tax. When they give you employment, when they promote you at work, you wouldn't want to take the promotion. Did you get it? Because I'm
going to pay more.
I'm going to pay more in taxes. So people would literally reject promotion because government is increasing the marginal rate of tax. So, but a cut in marginal rate of tax allows people to want to work more, seek employment, accept promotion. And all these would increase aggregate supply within the economy. Do you get it? So work is arguably an inferior good, while leisure its alternative. Alternative is a normal good. Now, look at what they said. They said work is an inferior good. Leisure is a normal good. Please, can you just oppose that? Why is work an inferior good? Work. Yeah.
Inferior good.
Yeah, work. The job you do, job, is an inferior good. Why is it an inferior good? What are inferior goods?
Inferior goods are I forgot.
Well, it's taking a toll on you big time. Okay, inferior goods are goods that consumers will buy when their level of income falls. Normal goods are goods that we buy or we tend to buy when our level of income increases.
Okay, how does that make job?
Thank you. You still don't get it, right?
No.
So, job, work is an inferior good, and I'm going to explain that to you now. Work is an inferior good because it is only when people do not have enough income, they start thinking about finding a job. What labor, a supply of labor, it's you making yourself available for a job, right? It simply means you're seeking for employment, you want to work for a reward. But people don't work. Some people would not work if they have income. So you start thinking about looking for a job. Okay, it is like in Africa, like okay, Nigeria that I'm coming from, they're like, when you don't have money, your parents are like, go look for a job. Why do they say you should go and look for a job? Or you continue to ask them for money, you continue to ask them for money. It's going to be a stage, you're going to get to a stage, you're going to tell you, you better go start finding work, you better go do a job, go find a work. So you see, they want you to seek employment because you don't have income. You can't continue to come to us every now and then. Does it make sense now? So work is what an inferior good because it's only when people do not have income they start thinking about finding a job. On the other hand, luxury or leisure is it's a normal good. The more income you have, the more the more time you want to stay off work. So we go to leisure because we have enough income. I want to go to Bahamas because I'm not going, I have the cash. I want to go to Bahamas because I'm taking off time off work because I have a lot of income. But if I don't have, I wouldn't try it. I wouldn't think about it. So that's why that's the difference between normal goods and inferior goods about how they are responsive to income. Okay. Does it make sense now, please? Yeah. Okay, great. So now we move on. Though that point here, a lot of people would find it difficult to explain. Like work. How is work an inferior good? But work is an inferior good. When you look at it on the perspective of you willing to find work.
You wouldn't find work if you have enough money.
You wouldn't want to work, right? Yeah. But when you don't serve, the next thing that comes to your mind is, yeah, I need to look for a job now, man. Even when you could ask your parents for money and they're like, we don't have. You're like, okay, if I'm working, I wouldn't even ask anyway. So you see, it's coming to your mindset that, I just have to work. So we'll move on anyway. So for free market economies believe that substitution effect of a tax cut is more important than the income effect, and hence tax cut increase incentive to work. And that is the fact. So a cut in tax will always create incentive to want to work. Because if taxes are cut, it increases your disposable income, which increases your purchasing power. If taxes are cut, firms will be making more profit because there's indirect relationship between tax and profit. So if taxes are cut, firms will have the incentive to produce more, and they might as well sell at a reduced price. So it's a win-win situation for government, individuals, and firms, all economic agents. Although a cut in tax might bring about deficit budgets. Because if a cut in tax is as a result of government cutting down or increasing expenses or increasing its spending below or beyond its revenue, if a cut in tax is reduced, if there's a cut in tax, government revenue in form of tax reduces. And if government has to spend, if government has to finance its infrastructure, public goods through taxes, it means government might as well run through deficit. And accumulated deficit will bring about national debt. Do you get that? So go to tax revenues and the Laffer curve analysis. For the Laffer curve analysis, it's simply talking about, let me show the audience the Laffer curve. This is the Laffer curve. So it's simply about why a fall in tax will increase, a cut in tax become an incentive, but a cut in tax, let me put it this way, if taxes are reduced, governments might as well make money from maybe from VAT or the rest. But an increase in taxes become an incentive for firms, for every economic agent. And as a result of that, revenue for tax would reduce. People will start thinking about, if government increases tax, people will start thinking about ways to avoid taxes. And that's about the Laffer curve. Do you get the point here? Yep. So I'm going to read further anyway. If cutting marginal income tax rate encourages people to work harder and more, then in theory, it could be that tax revenues will increase following a tax cut. For instance, if 10 workers each earning 10,000 a year per an average 25% tax, the total tax revenue and the stories are there. So the point I'm making is if government reduces marginal income tax rates, it is an incentive for people to want to work. So that means those who are voluntarily unemployed will become employed. That increases the numbers of people that will pay taxes. So that is the point I'm making here. So I think a cut in marginal rate of tax increases the numbers, the quantity of people, the quantity of tax, which might as well increase the numbers of taxes. Okay. The number of tax amounts paid to government. That is the point. So if government reduces marginal rate of tax, more people would want to work. And that might allow government to make more in terms of revenue through taxes. On the other hand, if government increases marginal rate of tax, people become disincentivized to work. And as a result of that, tax revenue would fall. Or people will start thinking about bypassing taxes. Okay. Do you understand? Yeah. So that's about the Laffer curve. So a cut in marginal rate of tax increases tax revenue for government, but a rise in marginal rate of tax reduces tax revenue for government. It's not the same as corporation tax, income tax. For corporation tax, which is probably progressive tax, it increases government revenue. But it has its own consequence too, because an increase in progressive tax might as well become a disincentive for people, and they start thinking about leaving your country. But for Laffer curve, it's simply talking about the marginal rate of tax. Thanks, Zanny. Do you get the point here? So the marginal rate of tax, if the marginal rate of tax is increasing, tax revenue fall for government. If marginal rate of tax is cut or is reduced, it increases tax revenue for government. I think the point is clear about Laffer curve. Is it clear? Yeah. Okay, great. So we'll move on. Okay, that's about that. Let's end this video here. It's okay. Yeah, I think it's more. I think maybe 10 minutes or so. So, okay. I'll be right back, please. Let me just pause it. The two videos. Yeah, thanks. So we move on. So go to income. Yeah, right. Where are we right now? Let's see. We talked about the Laffer curve, which is done. So the last paragraph here, they said changes in tax and benefit rates can also have incentive effects for those in work and on low income or for those unemployed. So definitely a change in tax, an increase in tax increases government revenue, yes, but not marginal rate of tax, other taxes. And an increase in tax increases government revenue, which might as well allow government to make, to spend on social benefits, to invest, to finance infrastructure. And if government is able to finance infrastructure through tax revenue, it could as well encourage or attract, become a state of attraction for foreign direct investment. And as soon as foreign direct investment comes into a country, they will create job opportunity and unemployment would fall. I think that is clear.
Yeah.
Is it clear, please?
Yeah.
So we go to income distribution now. Are you there?
Mm-hmm.
Changes in direct and indirect tax rate are likely to have an effect on income distribution. The first one is about what? About taxes.
Yep.
No. About incentive to work. Now it's about income.
No, like
Yes.
the first one was incentives, then Laffer curve, and now income distribution.
Yeah, but okay, Laffer curve is still part of the incentive to work.
Okay.
Yeah, because the Laffer curve talks about the reason why people would want to stop working.
Mm-hmm.
So it's still about it. So now we go to income distribution. Are you there?
Yep.
So for income distribution, I think I'm going to up this now. Okay, yeah. Okay. So for income distribution, it said changes in direct and indirect tax rates are likely to have an effect on income distribution. Direct taxes on income tend to be progressive. We already know that. All direct taxes, because direct taxes are CGT, that's capital gain tax, corporation tax, that's tax on profit, income tax, which are taxes on employees, taxes on sole trader, taxes on partnership, then inheritance tax for those who have a lot of property. So these are all progressive tax.
Mm-hmm.
So those on very low income pay no income tax, while those on very high income pay a high rate of tax than those on lower income. So in that's about direct taxes. So direct taxes are progressive tax. For indirect taxes such as VAT tend to be regressive. As income increases, households tend to spend less as a proportion of income and save more. So the point about regressive tax, it's still part of what we've talked about before. It's regressive tax because households now have more income and they start paying less. So it's regressive. It's regressive not because the tax is reduced. It's regressive because we all have those who have access to joining, those who have access to buy these goods have more income than one another. So yeah, we can have access to the same, goods, but do we have the financial capability to buy the same goods? So if it is 5, your income is 3, that means you can only buy one, or you can't even buy it. But if it is 5 and your income is maybe 10 or 15, 20, then you are taking few amount of money to buy. So it's regressive because you have access, but you can't, it's going to take large proportion of your own income to spend if you want to do the same as others. So there's access, yes. But how much is it going to cost you to buy? Are you spending the same proportion of your income as others? And that is why it is regressive. And regressive tax tends to allow high income earners to save more, while low income earners save less. It's also regressive that way. So, because once again is this, regressive tax will increase the gap between the rich and the poor. Do you know why?
Why?
I'm asking. So why do you think regressive tax would regressive here? What do you think would make regressive tax to increase the gap between the rich and the poor? How is regressive tax bring about income inequality?
It would
How can it? Yes.
Yeah, because they're both paying the same thing, but for one person it's a smaller proportion than the other.
Is that why the gap between the rich and the poor will continue to rise? Or
Yes.
No. Okay, let's look at it this way. I'm sorry. Yes, sir. Fine, sir. اتفضل. Yeah, we said regressive tax. Regressive tax would create income inequality. How? You said,
I said it would create income inequality because if how do I put this? It would reduce income inequality because
no, regressive tax,
it would increase, yeah,
income inequality, okay?
yeah, um, because we get people are paying the same thing even though they have different income levels.
On the perspective of spending.
Yeah.
Now, on the perspective of saving. When it is regressive tax, right? Regressive tax reduces your ability to buy if you are a low income earner.
Mhm.
It reduces your ability to save if you are a low income earner. So two things are happening to you, and that makes it regressive. So regressive tax increases the ability of it increases your ability to purchase because it increases your purchasing power, your disposable income as a high income earner, and it also gives you the opportunity or the ability to save as a high income earner. So on the perspective of spending, it is regressive. So on the perspective of saving, how does it increase the gap between the rich and the poor? Did you get my question?
Yeah.
Okay.
So let's put it like this. If a poor person and a rich person both pay the same tax,
Okay.
yeah, the poor person might spend most of their income just to live.
Just still talking about spending. I'm talking about saving. We've talked about spending. We understand that. Everybody understands now that it is regressive because low income earners will spend large proportion of their income on spending. And that allows them not to be able to even consume what the rich are consuming. And that reduces their quality of life.
Mhm.
Let's put it that way. So there's gap between the rich and the poor. Now, in the perspective of saving, how is regressive tax through saving create income inequality?
Because since you're spending the smaller proportion, then you have more to save.
Yes, how is saving? How can saving increase the gap? Or how can saving bring about income inequality?
Because the poor saves less than the rich.
So, oh, because I'm saving money and you're saying, oh, because you're saving money that you're saving more than I do, does that increase the gap between the rich and the poor? No.
I give up. I don't
Ah, give up.
understand.
Okay, yeah. Well, because saving, one thing is this: whatever you save in there does not have value. But the point is, the gap between the rich and the poor increases. There's income inequality because high income earners have the opportunity to save. And whenever they save, what do they do with the savings? They are able to purchase factor inputs. They will purchase land, they will purchase capital,
Mhm.
and this will come in a reward. It will come as a reward, income rent, as a reward, interest, which those who cannot save will not be able to. So savings allow you to purchase goods. Savings allow you to start a business, which simply means low income earners have to rely on you for income because you are able to save to start a job, to start a business. They are unable to save, so they need to be at your mercy to work, to get paid. So they always offer them their labor for wages, but you have the factors of production. So that is how savings, regressive tax, will bring about income inequality. Low income earners will not be able to save. One of the ways you can live, one of the ways to move out of poverty trap is savings. And you can only save if your income is increasing. Yes or no?
Yep.
But with regressive tax, you won't be able to save. And because you're unable to save, you cannot purchase land. You cannot save towards purchasing the land. You cannot save towards having a business.
Mhm.
So high income earners will be able to save towards purchasing a land, towards having a business, becoming an entrepreneur. So that increases their reward. And you are going to only have a reward from wages. They're going to have reward on land, they're going to have reward on capital, they're going to have reward as an entrepreneur. But you're going to only have one reward. And there's no way you want to be richer than your employers.
Yeah, okay.
Did you get it?
Yes.
So that's how regressive tax bring about income inequality.
Mhm.
It doesn't give you ability to save, and it is only when you save that you can earn more.
Yeah, I get it.
Okay, so we move on, right?
Mhm.
So that's about income distribution. Then they said the distinction between progressive, regressive, and proportional tax is made because it is important in the study of distribution of income and wealth. The more progressive the tax, the greater the link with ability to pay the tax, and the more likely it is to result in a redistribution of resources from the better off in society to the less well off. We need to distinguish between progressive tax, regressive tax, proportional tax, because it is in our ability to distinguish between them that would allow us to reduce the gap, that would allow government to reduce the gap between the rich and the poor. It's only when we are able to distinguish between them, we would be able to understand how to redistribute income. Oh, the situation of the country shows that high income earners are enjoying a better standard of living. Low income earners are not. So what can government do? Government would not take money from the rich to give to the poor. Government has to come up with a policy. And the kind of policy government will come up with is fiscal policy through taxation. And here on quote, it will be progressive tax. So officially, because you are earning more, you have to pay a certain amount of money. Then government will be able to redistribute that to the less well off. So you are better off, then government has to think about those that are less well off. Do you understand now?
Yeah.
So if the country is leaning towards regressive tax, government would understand that regressive tax is not ideal because it will reduce purchasing power and put low income earners into vulnerability. So government will think about that too. So government will decide anyway. It's the government of the day that decides the kind of taxes it uses to generate revenue. I think it's clear there.
Yeah.
So the impact on a change in tax revenue for the government on income distribution after tax will depend on why tax revenue have changed. For example, if the government increases the rate of value added tax or excise duties, the distribution of income is likely to become less equal. VAT excise duties have a regressive effect. They said the impact of a change in tax revenue depend on why tax revenue have changed. So look at the first one. They talked about VAT, value added tax or excise duty. Government might increase excise duty on maybe tobacco because it's a demerit good. Are you with me?
Yep.
So government wants to discourage smokers, and that's why government is, increasing or raising the tax on that. And for value-added tax, the rate of value-added tax is regressive anyway, but government might as well look at other aspects of it, like, on book, there's not gonna be VAT on book, there's not gonna be VAT on education, there's not gonna be VAT on this, on that. But whatever the case might be, government uses VAT to generate revenue. Clear?
Yep.
If there's a rise in tax revenues because of a rise in the top rate of income tax, which is progressive anyway, then the distribution of income is likely to become more equal because it's progressive. Government is taking from the rich to the poor. This is because the rise in tax revenue will be paid by top income earners, like I said, and not by low income earners. However, a very high tax, if very high rate of income tax encourages tax avoidance, the overall impact on income distribution may be less significant than expected. Here we call it unintended consequence. Is it unintended consequence?
Yep.
An unintended consequence is what?
Negative externality.
Unintended consequence.
No, it's it's government failure.
Government failure. Thank you. So this is unintended consequence because government didn't do this to make people to avoid tax. Government did it for a reason, and now the reason has been used against government. That's unintended consequence. So if government uses progressive tax to redistribute for the purpose of redistributing income, but if as a result of that, people start bypassing, avoiding taxes, it simply means the purpose of progressive tax would not have any significant impacts. in the economy.
Mm-hmm.
Do you get it?
Yeah.
However, if very high rates of income tax encourage tax avoidance. Yes, I said it already. So do you understand the point here? So progressive tax is good because it allows redistribution of income to be equal. But however, the problem about progressive tax is that it might encourage people to start thinking about avoiding tax. And if people start avoiding tax, it simply means it's not going to have any impact.
Okay.
If the rate of corporation, that's about progressive now. If the rate of corporation tax, that's tax on company profit rises, then the division of income is likely to become more equal. This is because a rise in corporation tax, the share of profit going to the government is likely to lead to a fall in dividend payments to shareholders. Shares are mainly owned by those on high income, so the income of high earners is likely to fall. If government increases taxes on profits, on profit, that is corporation tax. If government increases corporation tax, it reduces the share of profit, which is dividends. And who are those that own shares? High income earners.
Income earners. Yeah.
So that's why I say it is also progressive. I think it's clear.
Yeah.
So now we go to real output, the price level, and employment, the impact on taxes. Are you there?
Yeah.
A change in tax rates is likely to have an effect on real output, the price level, and employment. Some tax changes affect aggregate demand while others affect aggregate supply. So we start with aggregate demand. What is aggregate demand first before we go into further? What's aggregate demand?
Aggregate demand is, you want me to name the components or what?
No, the meaning of aggregate demand.
Aggregate demand is the total demand of the economy.
Yeah, the total demand within the economy. So what are the components of aggregate demand?
Consumption,
C,
investment,
I.
what's G? Um,
You said C plus I plus
G,
government spending. Am I just telling you? Okay, government spending
plus X exports minus
minus imports.
imports.
That's net exports. So that's about aggregate demand. Okay, so it says some taxes such as income tax on employees, national insurance contributions affect aggregate demand. A rise in income tax rates, for example, will reduce household disposable income. Households will then spend less. This fall in consumption will reduce the output demanded at any given price. This is shown by a shift to the left of the aggregate demand curve in figure 3, where we have, okay, oh, okay. We have the figure 3 here. Let me just show it to them. We have here, they said an increase in taxes will fall in aggregate demand. There's aggregate demand because aggregate demand is the total demand within the economy, which comprises of consumption, which is mostly what we want to talk about here. So an increase in income tax reduces the purchasing power of individuals. So which simply means disposable income for individuals will fall. And as soon as disposable income falls, the aggregate demand will fall left from AD1 to AD2. So people will not be able to spend as they used to spend. Because if consumption is reducing, consumption is part of the component of aggregate demand. We said aggregate demand equals C plus I plus G plus X minus N. This is aggregate demand. But what we're talking about is consumption C. So consumption is based on income. So consumption is based on income. So if income falls as a result of increase in taxes, it simply means consumption would fall. And if consumption is falling, aggregate demand would also fall. And that is the point here. So aggregate demand will fall here because income level has tax has increased. So shifting the aggregate demand curve leftward from AD1 to AD2. And as soon as consumption falls, prices would as well fall. Firms will not be able to sell as they used to sell. So they wouldn't have any other choice than to reduce the price of goods. So that's why the price level will fall from P1 to P2. And as a result of that, the income level of real output would also fall from Y1 to Y2. So an increase in taxes would reduce aggregate demand, shifting the aggregate demand curve leftward, real output to fall leftward, and the price level to fall. That's about aggregate demand. Then we have okay, yeah, that's what is being said. So let me interpret figure 4 for supply. Are you there? An increase in tax list will fall in aggregate supply. So here it could be corporation tax. So if government increases corporation tax, okay, no, it said VAT here. It said an increase in VAT, for example, leads to an increase in cost for firms. firms do purchase too from suppliers. So if firms have to purchase from suppliers and they have to pay VAT on it, an increased VAT on it. Okay. Okay, great. So if firms have to pay, if there's a rise in value-added tax for firms, it leads to an increase in their cost of production. And as soon as their cost of production increases, firms will become disincentivized to produce more. So the short-run agri supply curve will shift leftward from SRAS1 to SRAS2. And as a result of that, there will be scarcity in the short run. And with scarcity, the price level would rise from P1 to P2. I'm bringing about a leftward output from Y1 to Y2. The first one we talked about, figure 3, is about an increase in tax, an increase in income tax. An increase in income tax, I'm going to repeat that again. An increase in income tax reduces the purchasing power of individuals and their disposable income. And that reduces the aggregate demand, shifting it to left off from AD1 to AD2. And the price level would fall from P1 to P2. Real output will reduce from Y1 to Y2. That is on aggregate demand. And for aggregate supply, it's about VAT, which simply talks about an increase in VAT. An increase in VAT would increase the cost of production for firms. And if the cost of production for firms increases, they might not be able to charge higher prices. And what can they do? Before they could charge higher prices, they have to reduce the quantity they produce. And reducing the quantity they produce means real output will fall from Y1 to Y2. As the short-run aggregate supply curve will shift leftward from SRAS1 to SRAS2, increasing the price level from P1 to P2. And the price level will increase from P1 to P2 because demand will expand, supply is contracting. And because supply is contracting, it brings about shortage. And shortage or scarcity will bring about a rise in price. So that's about aggregate demand and aggregate supply. Is it clear? Is it clear, please? So go to trade balance now. I'm flipping with the camera. So I've explained aggregate demand, aggregate supply, and the impact on tax. So we go to trade balance. Are you there? An increase in taxes on households will reduce their disposable income. This, in turn, will reduce their consumption, including spending on imports. Now, individuals, when disposable income increases, or when the purchasing power of individual increases, when income level of individual increases, they do not only purchase domestic goods, they spend also on foreign goods. That means importation, they spend on importation too. And that is the point here. So an increase in taxes on households will reduce their disposable income. And because their disposable income is reducing, it reduces the amount of money they have to spend on importation. And that might as well improve the balance of trade. It will improve the balance of payment, current account. But here they're talking about the trade balance. So this in turn reduces their consumption, including spending on imports. And the trade balance will improve. Equally, a cut in consumption will reduce aggregate demand. With aggregate demand falling from what it would otherwise have been, firms will need less capacity to meet demand, so they will need to invest less. Less investment reduces aggregate demand, shifting the aggregate demand curve leftward also. So some of the cut in investment will come from cuts in imports of capital equipment, and the trade balance in the short term will improve. In the long term, it could deteriorate if reduced investment makes domestic firms less internationally competitive over time. So that is the consequence of an increase in taxes. An increase in tax reduces disposable income. So if disposable income reduces, spending on importation reduces. And if in the short run, it improves the balance of trade. But the problem is spending on importation could be importation of equipment, and that is capital goods. And for outputs to increase, you need to invest further on capital goods. So if the investment on capital goods comes from importation, that means firms will not be able to invest in capital goods. And as a result of that, output would fall. So in the long run, it deteriorates the economy, especially if the country will become less internationally competitive. And if the country is less internationally competitive, it declines or deteriorates the balance of trade too. So that's about the trade balance. So a cut in tax, a rise in tax will have impacts in the short run and the long run of the trade balance. I think it's clear.
Yeah.
Now go to FDI flows. For FDI, we're talking about foreign direct investment. Foreign direct investment is normally defined as the investment by a foreign company, where the foreign companies acquire 10% or more of the shares of the domestic company. For example, it could be Volkswagen, the foreign company setting up a new vehicle manufacturing plant in Vietnam and owning 100% of the company it's set up in Vietnam. It could be Volkswagen buying an existing vehicle manufacturing company in India. It could be, yeah, all these are foreign direct investments. So the point about foreign direct investment is that it means certain company, a multinational, is able to, put inward investment into the country. So, here, they said FDI represents a way to increase investment in their own economies and to boost household and employment. For government, it represents a way of increasing tax revenues because the ongoing operation will pay a variety of taxes, from taxes on labor employed to sales tax such as VAT to taxes on profits. Now, let's take it one at a time. For VAT, uh, for foreign direct investment, foreign direct investment simply means government is allowing foreign direct investment simply means firms, multinationals are setting up in the country. And if multinationals, when they set up in the country, they are setting up to increase their own output. And because of increasing their output, it brings about opportunity in terms of employment, which is one of government's macroeconomic objective. It allows employment to increase in the economy. They're going to pay taxes on their profits. Government is going to make more taxes on revenue through VAT. So it's a win-win situation for government, for FDI. So that's why most of the time government would want to, improve on their own infrastructure to encourage FDI. Because as soon as FDI comes into a country, FDI would increase the output of that country. And whatever is being produced in that country, it will count on the balance of trade, on the balance of payment of the country. So some countries have chosen to encourage FDI inflows by offering lower rates of tax. Another way to encourage FDI is to cut taxes or to reduce taxes on profit. Offering low rates of tax on investment, in particular, some countries have deliberately lowered their rates of corporation tax. The tax on company profits, the reason is that any loss of tax revenue would be more than offset by an increased economic growth and prosperity resulting from the investment. Also, in the long term, the government may collect more in tax despite the rate of tax being lower, because if investment had not been made, no tax would have been payable. So, government might come up with increasing tax here. Government might lower tax to encourage foreign direct investment. But as soon as foreign direct investment comes into a country, it is difficult for them to want to leave because they've come with infrastructure, they've come with technology, and all these things might bring about sunk cost. So this simply means government might as well lower tax, but still make more in taxation. Because as soon as FDI sets in, they're going to employ workers, they're going to pay taxes, and it's a win for government. So that's the point I'm making here. So if FDI continue to come into a country, it increases output of that country and it brings about economic growth, leading to economic development also. Do you know there are difference between economic growth and economic? What's the difference between economic growth and the development?
Okay, so economic growth and economic development.
Yes, what makes them differ?
The difference is like one is about the increase in the economic growth is about the increase in the country's output, and economic development is more about the improvement in the people's quality of life.
Yeah. So for economic growth is simply about increasing output, which is quantity, while economic development is about increasing the welfare of people, which is the quality of life. So that's about economic growth and economic development. Now, the problem with tax competition is that it can become a race to the bottom. If enough countries lower their taxes in an attempt to attract FDI, lower taxes will have little impact on firms' decision about where to make the investment. However, countries will see significantly lower tax revenues because all the existing firms in the country will now be paying lower tax. Using game theory, the strategy only works for a country lowering its tax rates if enough other countries keep their tax rates high. If every country lowers their tax rates, every government simply loses tax revenue. So game theory then.
Mm.
So the prisoner's dilemma. So the point is there's a gain if a country reduces its tax rate in relative to other countries. But if if it becomes a tax competition, there's no gain. It's a lose-lose situation because the game theory.
Okay.
Do you get the point here? So if country A reduces tax, it could attract foreign direct investment. But if all countries reduces tax, then it now depends on that each firms to decide where to invest. So that means other factors will be put in place.
Cool.
Do you get it?
Yeah.
Then corporation tax rates have become a major international issue in the 2000s. In the 2000s, okay, transnational companies have become increasingly aggressive about moving their assets around the world to avoid paying taxes. If a transnational can avoid billions of dollars in taxes by opening an office in the Cayman Island or sending all European sales through an office in Ireland, because Ireland has a low corporation tax anyway. Then there has been some foreign direct investment in the Cayman Island and in Ireland, but it has come at a huge cost to many other countries. So here they're saying multinationals might as well avoid tax by directing their funds to countries with low income tax, with low corporation tax. And that's a lose situation for the host country. So the host country will not be able to charge them. So the taxes will be paid in other countries that do not even have any reason to be part of their operations. Transnational companies, multinationals, they do that. So if this country is charging higher tax and they need to be in that country, they'll find a way not to pay their taxes in that country. I think that point is clear there, right? Is it clear, please?
Mm.
Is that okay? Okay, let's see. Does that end the chapter? Oh, that ends the chapter.
Yeah.
Okay, so that ends corporation tax, and I believe it's more, educative and purposeful. So the live will end now, and thanks for everyone who have joined the live. I see you other time. Bye and cheers. So we have questions today.
Mm.